This is Enrich Your Life, a podcast about financial health, all things investing, life planning, and smart decisions with Richard Leimgruber.
Hello and welcome to another episode of Enrich Your Life, where I speak with financial professionals about many different topics. The idea is to provide you, the listener, with very valuable information that you might not get from public resources. I'm your host, Rich Leimgruber, and I have over 27 years experience helping clients and small business owners provide protection, value, and help them grow their assets, making sure that all of their risks are covered. Today, we're diving into one of the most important topics that are mostly overlooked for any component of a financial plan, and that is long-term care planning. Many people assume it's something that affects only older people, or that Medicaid, Medicare, or family members are going to help them through the process of getting long-term care. But the reality is very different. The majority of Americans will need some sort of long-term care during their lifetime, and the financial impact can be significant, especially here in New York and across the Northeast, where the care costs are among the highest in the country. The goal of today's conversation is simple: education and empowerment. We want you to walk away with a clear understanding of the real cost of care, the likelihood of needing it, and the different ways families can prepare, whether it's through personal savings, insurance strategies, or a combination of the both. Joining me today is Ray Hickson, who is a certified for long-term care, a regional vice president with Advisors Insurance Brokers. Ray specializes in long-term care insurance planning and has guided countless individuals and families through the process of preparing for one of the most financially and emotionally significant events, and he's been doing it for over 25 years. Welcome, Ray, and thank you for joining me. I'm looking forward to helping our listeners better understand how to plan ahead with confidence. And if there's anybody that can help them do that, it's certainly you.
Thank you.
We've known each other for a long time. Yeah, you know me longer than most people know me, so I got to be on my best behavior, as they say. Ray, you've worked with numerous insurance companies, including American Express Assurance, GE Capital, Genworth, and even John Hancock. And I'm sure you've seen more conversations about long-term care planning than most. Can you give us some background as to how you got to where you are here today?
Sure. Out of college, I actually worked for a bank, and I became a branch manager. But I started getting a little bored of it, and I started talking to my customers. And one guy came in who worked for American Express and mentioned that American Express was starting a long-term care division here in the state of New York. I mentioned to him, I'm trying to maybe get out of banking. Why do I want insurance? He basically said, well, you're the one looking for another career. But at that time, I had a grandmother who was bedridden with strokes and seizures. So when he talked about long-term care, I kind of got the idea what he was talking about, but really wasn't sure. And I met an individual who took me through what long-term care planning is, what long-term care is, and the decision was made 1990 to join, at that time was American Express and long-term care planning. And then I called on hundreds of people over a course of a number of years and helping them plan what will occur with planning for long-term care.
Right. And since then, we know that Americans are living much longer.
Correct. One of the difficulties, we know we're going to live into our 80s, and the longer we live, the chances are greater we're going to need care because different ailments will occur as we hit our 80s and 90s.
Yeah. I always say with the advancement of medical care, they're basically keeping us alive for longer, but what's the quality of life for that, right?
Well, if you're in your 90s and doing everything you want to be doing, absolutely fabulous.
Sure.
But clearly, longevity plays a role with long-term care. If we're living into our 80s and 90s, the chances are we're going to have some type of ailment that creates a situation where we're going to need help from somebody else.
Approximately 70% of adults 65 years or older will need some sort of long-term care during their lifetime. Approximately 7 out of 10 older adults will need some sort of help with their daily living activities. We'll go into what those are. 1 in 5 Americans turning 65 may face over $200,000 of long-term care costs before they pass away. 24% of those need care for more than 2 years. So it's not just a short-term thing. And then family caregivers provide a majority of that care.
Correct.
And that's where there's a personal story there for me. When I was 12 years old, I went on a cruise, my entire family, and my wonderful Grandma Betty, fell on the ship and got wedged in between the doorway and broke her hip. And she became bedridden. And for the last several years of her life, I would come home from school and I would make sure that she was being taken care of because we didn't have the money at the time to help her.
Wow.
And there were times where we did have some help, and there were times where the help didn't show up. And we were a middle-class family living on Long Island. And I, unfortunately, had to help my grandmother wash, change bedpans, and do these other things because we didn't prepare. And so I'm very familiar with it. If anybody out there is thinking that this is not going to happen to me, it's the same situation with anything in life. It can happen to anybody, right? So the national average from 24 to 25 of nursing home private room care is $127,000 a year. Assisted living is $70,000 a year, and home health aides are over $77,000 a year. Here in New York and in the Northeast, it gets even worse.
Correct.
New York nursing homes are anywhere from $150,000 to $180,000 a year. Assisted living is anywhere from $75,000 to $90,000 a year. So when you live in a very enriched place like New York or the East Coast, it's going to cost you a little bit more to take care of your relatives. So let's get into some of the caveats of what is long-term care.
Long-term care is basically a situation where an individual now no longer can take care of themselves, either physically or cognitively. They may have something like Alzheimer's, which represents about 50% of these situations, people needing care, or physical, where they need help with their activities of daily living. Maybe they've had a stroke, maybe they've had an injury, maybe something like your grandmother who breaks a hip and then doesn't heal, and they're bedridden or simply can't get around and do things they want to do. That's what long-term care is. Long is usually defined as someone needing care for at least 90 days. So someone may need help with their activities of daily living if they've had hip surgery, but it's only going to need help for 30, 60 days. Usually defined as someone needing care for more than 90 days, and it's permanent. It could be a year, 2, 3, 4, 5.
And so when we talk about what options are available for families who need to give that care, we have home-based care, right? We have adult daycare centers, independent living, assisted living, and then eventually skilled nursing home, right? Which is where the costs really get high because now if you need to take medicine, you need to have a certified nurse there or a registered nurse who can administer those medications. So I guess the question to you is, for our listeners, when is the ideal time to start exploring how to protect your family and really determine what costs you should protect against?
So most people who need care is going to be provided care by a family member. So it's usually going to be a spouse. Now, if the first spouse passes away, the second person is alive, and usually that person lives longer, then children get involved. But the challenge is if the children aren't local. They live in New York City, you're living in Albany, New York, how do kids help provide the care? Right. So they then go through the process of looking at home care first. They hire a home health agency. And depending on the person's care needs, that will change the cost factor. Some might need 24-hour care. Some person might need only 8 hours per day of care. And that will change how much a family is going to have to adjust their either life or their finances. But clearly, the best time to be looking at the topic, I feel, is somewhere in the early to mid-50s. And typically, because an individual in their 50s has a parent who's already reached 80 and 85, and they start looking at the situation through their parents, and they turn around and it's like, well, what's my plan going to be? So when should someone look at this? Pretty much in the mid-50s.
You're saying I have a couple of years left, and now I got to start looking into this.
Well, the challenge also is someone reaches 60 and 65, do they have a health change themselves that may exclude them from looking at insurance planning for their solution? They then get in a point where I can't get insurance, so what do I have to rely on?
Right.
Family.
Right, and as you get older, not only do you get older, and insurance companies, if you're still in good health, are going to charge you more because they can't collect as many premiums.
And anything to do with insurance usually is age-based. So life insurance, long-term care, disability, age-based. So the older you are, it's going to cost more. So from a financial point of view, looking at younger is a lot better financially.
When you meet families, what surprises them most about the risk of long-term care?
Well, the risk is simply, and you had identified some of those probabilities. Most people think, well, it's not going to happen to me.
Yeah.
But I will contend if I talk to any couple who are 55 years old and ask what happened to your four parents or are they still alive, I will contend that 1 in 4 of their parents have needed care. And that goes right to your statistic about 24% of people needing care for at least 2 years. So from that point of view, it's right on. Most people will have an experience of an immediate family member needing care if they reach into their 50s.
And so a couple of years back, maybe 10 years back, New York State actually developed what was called a partnership plan.
Yes.
And since then, they've stopped that.
It became too expensive for carriers to promote the product. So right now, New York State does not have a partnership policy. I have one myself and my wife.
That's great.
But there's no carrier here in the state of New York that's now providing a partnership policy. Other states are, but not New York.
Right. Okay. So that's good to know. And obviously, we're seeing a large demand for long-term care insurance as the population ages here in New York. Do you see the cost of sending somebody to a long-term care facility going down?
Never. It will never happen. That's a guarantee.
Yeah. And why do you think that is?
Well, labor costs. So
Right.
if you're hiring someone to provide care, either in a home environment or in a facility environment, salaries always increase. The cost of employing someone just increases. You're providing health insurance for that employee who might be providing care. That increases. Cost of just doing business from real estate points of view to taxation points of view. It always increases. So the cost of care will never decrease. And it probably increases the rate of inflation, maybe 3 or 4% each year.
Yeah, a little bit higher than inflation, right, on average?
Right.
Yeah.
So we have inflation about 2%, 2.5%. Cost of long-term care inflation is probably about 3 to 4% per year.
Sure. Understanding how much long-term care costs is the first step to understanding how to plan for those potential costs. So what mistakes do families make when estimating future costs?
They just don't know. They'll know if they've had a family member go into an assisted living facility or nursing home. Home care is a different animal. They may have provided care themselves, so they're not aware of what the costs are for home care. But if they've hired a home health aide for a family member, then they will have an idea. But if that was 20 years ago, they're going to lose track of what the costs have increased over those period of years or decades, and they just simply don't plan on those costs. They think they have enough for retirement, but they haven't planned anything about needing care and how much that may cost and how long the cost may last. I don't always recommend people covering every cost because they will have retirement income. It could be Social Security, it could be pensions, it could be RMDs. So most individuals don't need to cover the entire cost of care, but they should have at least a good chunk of the cost covered by an insurance policy.
So you can do a combination.
Sure,
And
no
so let's
question
go
about it.
over what ways you can pay for long-term care. You could pay with your local savings,
Correct.
right? Back 20-something years ago, one of my clients that I was working with, I'll never forget her, she passed away at 102. And right before she passed away, she redeemed her last amount of money out of her portfolio to pay for her long-term. And her family wound up getting absolutely nothing from, you're talking millions of dollars over the years.
Yep, no question about it.
So you can use your savings. Most people would say, well, our government's here, right? Medicaid will protect us.
So there's Medicare and Medicaid. So
So
Medicare is more associated with hospitalization, doctor visits, things like that. Medicare, the maximum Medicare will ever pay for long-term care services is 100 days.
Yep.
When a person may be, on average, needing care for 2 or 3 years, Medicare isn't going to do the job for them. And it was never intended to. There's Medicaid, and that's for individuals who really don't have much in the way of assets to pay for care anyway. So a lot of people rely on Medicaid, again, if they don't have much in the way in savings and they're hitting their 70s and 80s, and how they're going to pay for care. So a care provider will bill Medicaid for taking care of an individual, either in a home environment, an assisted living facility, or a nursing home.
Right. And one of the things that I understand is that if somebody thinks Medicaid is going to come in and save the day for them, the first thing they have to do is fill out an application. And in that application, they're going to ask about your asset. They're going to ask
Correct.
about your sources of income.
Correct.
And there's a spend down. In New York anyway, you have to spend down almost all of your non-qualified assets up to, I think, over
Correct.
16,000 or something.
Correct. Right. So they're not going to be forced to sell or liquidate qualified assets, retirement assets. But if they're receiving income from those assets, that income has to be used against the cost of care. So if their income, their portfolio is $100,000 a year, they're going to be forced to use that $100,000 to pay for care.
I've even seen them come back and say, I know you're taking your requirement distributions, but we want you to take more to help offset the cost of it as well.
New York State used to have a Social Security longevity table. Now they're going back to more life insurance longevity tables, which is shorter, which is forcing the individual to provide more income against the care if they're using Medicaid dollars.
Yeah. Yeah. And then the other thing is we got to sell mom and dad's house because we have no money
Sure.
to pay for care.
Sure.
And
They're forced
one of
to.
my biggest things is no, don't do that.
Well, if the individual's in the house, they can't be forced to sell the house.
Right.
Right? But if they move out of the house, it becomes an asset that could be liquidated to pay for care.
Correct. So if you sell that house and now it becomes a liquid asset, Medicaid's going to say you got to use that money
Correct.
before. So I always
Correct.
advise clients to, hey, don't sell this and hold on to that house because you need a place for them to live.
Right. So somebody reverse mortgage. I'm a believer in them. A lot of people are not. But if someone is single, living in a house, $500,000, $750,000, equity in their home without being forced to sell the home, then they can stay at home to pay for care. So
Right.
that's a belief I have.
Right. The last way to pay for long-term care is family support, right? Children paying
Right.
for their parents.
Yeah, you don't really see that too much. I wish I could say I see that more, but most children aren't going to be paying for mom and dad's care. Either mom and dad's money is being used, or at some point they may enter Medicaid, and the children are going to allow the state and the federal government to pay for care.
Right. So one of the things that we always say is if you can always plan out for the future, we can anticipate what they're going to need. We always talk about long-term care, long-term
Right.
care insurance, right? How buying long-term care insurance can help protect the family. There are all kinds of policies, right? Each policy can be designed based upon the needs of the insured.
Correct.
Here in New York State, unfortunately, there's only one insurance company that's still selling the straight long-term care policy,
Correct.
Mutual of Omaha.
Right, the traditional type of long-term
Traditional.
care.
So let's talk about the traditional policy versus the new hybrid long-term care life insurance policies.
Sure. So the Mutual of Omaha, which is your standard company for providing traditional long-term care, just provides benefits for long-term care.
Right.
Very flexible. They've been around for 30 and 40 years. That's still a product that is looked at by most people. But now we have these hybrid policies that incorporate life insurance. And it goes to the question of, well, if I never need care, but I bought this policy, what happens? Well, this type of hybrid policy says if you die and never needed care, there's a death benefit that goes to some type of beneficiary, a spouse, kids, grandkids, et cetera.
Versus a traditional policy, if you pass away and never need it, the insurance company keeps the premium.
Right, which is true of like most types
Sure.
of insurance. So you have homeowners insurance and car insurance. If you've
Yep.
never filed a claim on your homeowners insurance policy, you live in your house for 40 years and you pass away or move out of the house, the insurance company's not sending any money back. But hybrid policy become a lot more valuable, a lot more flexible, and looked at by a lot more people because it answers a question of if I never need care, what happens?
Right.
Well, these hybrid policies will provide a death benefit for family members.
Let's get into both policies have similar, I guess, phrases and benefits, right?
Correct.
So there's a benefit amount, there's a duration of benefits, elimination periods, and then inflation riders. So the main thing is if somebody has a long-term care policy or one of those hybrid life long-term care policies, and they have a certain benefit, all of a sudden, mom's not doing so well, we're going to need to look into that long-term care policy. First thing we need to do is we need to make sure that they cannot do 2 out of the 6 daily living activities.
2 daily living. So any of these policies that provide anything to do with long-term care, the individual is going to have to be certified by their physician or some medical professional that they need help with 2 of 6 activity daily living, which are like dressing, toileting, eating. So if you need help with 2 of those 6, that will open up the policy for usage, or if the person has a cognitive impairment.
Right.
Then those policies will have what's known as a monthly benefit. The policy will pay $9,000 a month against the cost of care. The policy may last 2 and 3 and 4 years, depending on how much coverage they wanted at the beginning. Has inflation protection, meaning you bought the policy when you're 55, but you don't need care until you're 90. The policy should hedge itself against the cost of inflation.
Right.
And you said elimination period, which is a form of deductible, and that's usually expressed in number of days. 30-day deductible, 60-day deductible, or 90-day deductible.
And usually most select, I would say, 90 days because it reduces the cost, right?
Right, and Medicare may cover up to 100 days. So the idea, if you get Medicare coverage, you don't necessarily need to have your policy start from day one.
You do need to reach out to the insurance company, start the process, start that 90-day or 30-day or 60-day waiting period.
Correct. Once it's certified by your physician and you start incurring costs, that starts that deductible period.
What if somebody never contacted their insurance company? They've been using Medicare for the last 90 days and realize, oh my God, we forgot we had this policy. Is it retroactive based upon when the doctor wrote those notes?
It can be, right.
So,
if the family forgot mom or dad had a policy because they stuffed the policy in a safe deposit box, the insurance companies will go back in a period of time and look at when the individual first started needing care and the costs associated with it.
Is there any database out there that somebody can look at and say, hey, did my parents ever have life insurance? Did my parents ever have long-term care?
Not to my knowledge.
Yeah, maybe that's a new idea that we just came up with.
Well, I'm a big believer in policy reviews for financial professionals yourself. Ask your clients what type of life insurance policy you have, what type of long-term care policy you have, so everyone knows what they have. But also, if you purchase a policy, make sure the kids know you have a policy and don't put it in a safe deposit box.
Right, and pay your premiums.
And paying premiums is always valuable.
If somebody's been paying their premiums for 20 years and they forget to make a payment and the policy lapses, right?
Right. Well, most policies allow the individual to name a third person to be notified in case that policy is going to lapse.
Great.
So that's one line of defense. The second is there'll be late notices sent out to the individual, 2 and 3 late notices. Sure. But if they go a year and a half forgotten to pay and they didn't have any type of cognitive impairment, then they may be out of luck.
Yeah.
But policies also do allow, if the individual has a cognitive impairment, to have an extended grace period, up to 9 months.
Okay.
If Alzheimer's and if you're going to pay the premium, the insurance company can go back up to 9 months, get that payment made, and then the individual can file a claim.
Right. And so that's one of the benefits of working with an advisor who can actually take a list of all the benefits they have, all the protections they have, insurance, disability, whatever it might be, and just create some sort of a list of here are the things that your parents have.
Right. Also, if a financial advisor is an agent of record on the policy, they may very well get a late notice for that client of theirs.
When designing a policy, what do most people typically look for?
When I usually come to a table and ask what type of finances the individual has to begin with, because everyone can't necessarily afford the same amount as an insurance premium. Clearly, wealthier people can afford more, and they can purchase more benefits. Someone with maybe not as much in the way of finances but still need coverage, you have to tailor the coverage to really the financial ability to pay the premium.
Right. Making sure that you're going to be able to not only start paying, but continue to pay it and not run out of money.
Exactly. Most individuals will know what they can afford and not afford, but a financial professional will help them and guide them saying, this is what you can afford and maybe what you can't afford.
Sometimes I see clients have an option through work benefits of a long-term care policy.
Right. So there are group policies with some employers out there. There used to be a lot more that you don't see them as much as you used to. Those policies typically are fairly basic. They can get a basic policy maybe through work and supplement with another more robust policy.
And if you do a group policy, whether it's term insurance, long-term care, and all of a sudden you lose your job or you decide to move on, those policies typically go away, right?
Well, not necessarily. Let's say you bought a group policy, a long-term care group policy through work, and then now you retire, because most people will retire at some point. So instead of that premium being deducted from their payroll, they'll go on direct bill, and the individual will get a premium notice sent to their home.
Okay.
So
and
does
the policy premium pop up when you're no longer part of a group?
No.
No? It stays about the same?
Correct.
That's great. Awesome. Which 70% chance of needing long-term care and costs exceeding over $100,000 annually. In many cases, planning early is crucial.
No question.
Without preparation, families often face rapid depletion of savings, limited access to quality care, and stressful decisions on loved ones. Planning ahead ensures more flexibility, better choices, and financial protection. Have the conversation with your parents. Have the conversations with your siblings. Make sure that the most responsible person is involved in planning here. Correct. One of the things I've seen is siblings, when it comes time, mom and dad need help. Who's stepping up to the plate?
That's always a challenge. If you have 3 kids, which kid is going to be doing all the work?
Right, exactly.
Now, that also leads a lot of people saying, Well, I have 3 children. I don't necessarily want one child being burdened by our health.
Right.
So a long-term care insurance policy of some sort reduces the burden on the children.
And the conversation between those siblings and the family members, when should that be taking place?
I'm going to say most parents who are going to be looking at coverage, their kids are going to be in their 20s and 30s.
Right.
So the kids aren't really stepping up to have a conversation with mom and dad. And once those kids are maybe 50 years old, well, the parents are now 80 and 85. The conversations are not happening.
Right. And if the listeners today are sitting here and they're interested in hearing more, tell us what is one action after hearing this episode that you think they should take.
Contact Rich.
Contact me. Contact
Yes.
me or your financial advisor. If you
Exactly.
don't have one, ask friends, ask family members who they use. Most of my referrals come from clients who refer their friends, their
Sure.
family. What I would say is don't keep it a secret. I can help people who want my help. I can't help people who don't call me. So you're absolutely right there. And how do people reach out to you, Ray, if somebody is interested in learning more about the coverage that you can help them provide?
Well, what I'll say there, Rich, is they'll contact you, then you can contact me, and I can help you help them.
There you go. That's awesome. Well, I really appreciate this information. Anybody is listening and they have more questions, like Ray said, call your financial advisor, call me. We're more than happy to give you all the information that you need and look to see what options you have. The sooner you can get started, the better. And I would like to thank you for coming in today and taking this time. I think it's a very important conversation that we should be having. And please, if anybody's listening to this and they think that somebody they know could really listen to this information, share our podcast with them. You can go to enrichlifepodcast.com. And we're also on all the other social media channels like TikTok, Facebook, as well as Instagram. And we're also on all podcasts. So if you listen to iHeartRadio, if you listen to Spotify, Amazon Music, we're on all of those podcast sites. So until next time, and thank you for listening. Have a great day.
Thank you very much.
Thanks, Ray.